Hey friends, welcome back. So you guys have seen on my channel that I usually talk about equity research, macro strategy, portfolio outlook, and even life strategy as it relates to my career. Now, today's video is going to be on investor education. Specifically, I will be sharing with you how CFA Charterholders use fundamental analysis in their equity research. So please note that this will be the first video out of several that I will create throughout the course of the year to help you master this skill. If you're new to my channel, welcome. It's time for us to start the journey together. If you're studying for the CFA exams, this is going to be the perfect video for you to refresh on that knowledge. And if you're a returning friend, it's time for me to share deeper insights to add on to the existing insights that you already have. And if you are a Patreon member, I just wanted to let you know that it is my honor to serve you as your investment strategist inside my inner circle with exclusive research and content. Now, this video has been designed to be timeless, so save it in your watch later tab and refer back to it if you ever need to. I would say that this video is designed a little bit more for beginners and intermediate level investors. If you are very advanced, then I would say that this is a nice refresher of what you already know. With that said, let's get straight into it. Here's what we're going to cover today. I'm going to talk about how professional fund managers and their analyst team use different ways to analyze and forecast revenue and operating costs, which are among some of the most important details in equity research. I'm going to walk you through how a lot of fund managers use forecasting methodology that we learn from the CFA curriculum. And then I'll talk about some of today's stocks inside this educational video so that it blends academic elements with real world driven situations. And by the end of this video, you will have a stronger grasp of how professional analysts analyze revenue and operating costs. And like I said, I'll cover more content like this in the future. So if you enjoy this, then definitely hit that like button and subscribe. Okay, so the first thing that we're going to do when starting equity research is start looking at the company's income statement. And if you're a beginner, I almost always recommend reviewing the income statement first because it's like a profit and loss statement. It essentially tells you how much money the company has made in sales, what were the expenses, and therefore what are the profits. Since in the stock market, most companies derive the majority of their value from future cash flow generation, the income statement is a really good start to model the company's future sales, expenses, and earnings. In addition, we can use the income statement as a starting point for modeling a company's balance sheet and cash flow statement, which are financial statements that I'll discuss in future videos down the road. Now, diving deeper into revenue analysis, you should take note that most companies receive revenue from multiple sources. And because of that, here are some of the major details that you want to know about when it comes to revenue. A lot of professional analysts, they're going to analyze revenue in several different ways. I'm going to show you three ways. The first is segments. The second is through geography analysis, and third is product line analysis. So I'll walk through those three in order. So when it comes to segment analysis, it's about looking at what different areas of the business generates revenue for the overall company. So the reason segment analysis is important is it lets you know which area of the business is most important to investors. Here's an example. So when it comes to Microsoft, a lot of casual consumers really only know Microsoft for its Windows operating system. But more sophisticated retail investors and institutional investors would know that the core driver of Microsoft's business today is really its commercial cloud segment. And investors are paying attention to the fast-growing, high-margin segments that exist with ever-expanding total addressable markets. Sometimes the narrative of a segment growing very quickly within a company can cause hype. And sell-side analysts will use these narratives to upgrade their forecast for the companies under their coverage. Now, the next point that a lot of analysts look at is geographical analysis. Which region of the world does the company derive most of its revenues from? And is there an opportunity to penetrate into that market further? Attempting to answer that question makes a market of people who will have different conclusions until the earnings data confirms whether the long holders or the short sellers were ultimately correct. As an example, Roku is one of the names that has been highly contested in today's market and would serve as a great case study. So at today's valuation, Roku's sales multiple is sitting around 9 times sales, which is approximately 20% of a discount compared to its 5-year average. Now, the future of the valuation will depend on many factors, interest rates being one of them, but among one of the more fundamental ways to look at the company is its international expansion plans. As of today, Roku holds roughly 36 to 38% of the US market, which analysts are concerned has peaked. Now, to grow further, Roku is going to need to grow internationally in Europe and Asia to offset a maturing market in the US. This is an example of how analysts use geographical analysis when it comes to fundamentals. Now, the third point to focus on is the product line analysis. And for most retail investors, this is definitely one of the areas you should learn. This type of analysis is quite relevant for companies that have a small number of products, but they account for most of the company's sales. An example of this would be Twitter. Twitter generates approximately 85% of their revenue from ads and 15% from data licensing. As a result, the street is very focused on the quality and effectiveness of Twitter's ad platform, while also trying to understand how Twitter fits into the greater social media ad budgets where companies can choose from Google's YouTube, Facebook, Pinterest, and Snapchat. Now, a deeper analysis of Twitter's product would reveal that their ad solution is designed for brand marketing. Brand marketing means delivering impressions to help customers at the top of the marketing funnel to know that you exist. Their current ad product is very different from Facebook or YouTube, which focuses on an advertising format called direct response. Direct response advertising is designed to help marketers place an ad that is going to help them convert viewers into customers. Now, Twitter's future will heavily depend on the direct response product that they're building, since it will play a crucial role as to how quickly this product grows within their revenue segments. Now, Twitter is trading at 6 times sales. So relative to its history, it's inexpensive. And its user network is also a lot larger than it was in the past several quarters. Now, the reason Twitter is trading at a discount is that I think the street has lost faith in their projections along with the current market-wide situation. Now, in my inner circle on Patreon, my research conclusion comes to highlight that their early 2021 investor presentation, which marked a goal of 315 million users by the end of 2022 and beginning of 2023, was too ambitious. And the company, which has a little bit over 200 million users now, has really little chance to get into that size 12 months from now. So here, when we analyze the product line's potential, we also have to compare it to the backdrop of unproven management execution. And in my research notes on Patreon, I rate Twitter a weight. Now, it has incredible potential, and of course, it will rise in a rising tide, but relative to other opportunities, there are other companies that can do better if stocks recover from the recent downtrend. Now, that said, the downside for Twitter from here is greatly reduced. So anyone who likes this name now has a potential attractive long-term entry point. Now, of course, there are more techniques than this, but this is a neat summary. Now, to give you a deeper sense of where you can find these materials for your own research, you can individually go to the company's investor relations websites and find the annual reports for this data. In addition, sometimes the websites will include industry conference notes to help you understand management's thoughts on how it intends to innovate going forward. Now that I've finished talking about revenue analysis, let's get into the greater area of finance, which is forecasting. Forecasting is naturally very subjective, and it's always being hotly debated as to which method is better, but I'll use standard methodologies from the CFA content to give you some starting points. Now, personally, as an independent strategist, I think that revenue forecasting with precision is exceptionally difficult. But for academic purposes, it's useful to at least know the theory of the approaches. So I want to take a moment to walk you through it because it could be educational and serve as a starting point. So in terms of revenue forecasting, there are two ways to model revenue according to CFA content. Number one is growth relative to GDP growth, and number two is market growth and market share approach. So I'm going to start with the first one, growth relative to GDP approach. In this forecasting method, analysts will forecast the growth rate of nominal GDP, which to define for you is it measures the company's gross domestic product using current prices without adjusting for inflation. And contrast this with real GDP, which measures a country's economic output adjusted for the impact of inflation. Now, just as a reminder, revenue is the multiplication result of price and volume. And a lot of analysts will use either nominal or real GDP to project volumes, and then a forecast for inflation to project price growth. Now, you can see that this is highly theoretical because US GDP is sometimes completely uncorrelated with any individual company's sales volume, and sometimes not every company can raise prices as quickly as spot inflation rates released in terms of monthly data. As an example, my company Tigerway is a regional player in the college-bound educational consulting space. And despite inflation being at 7% in the latest CPI report, I have not raised our tuition prices by 7% in the last year. My strategy is to keep price inflation low to keep growing my market share. And since 2018, we as a program have raised prices by only about 10%. At the end of the day, as a small business owner who is looking out for the families I serve, I prioritize delivering value first and rely on referrals, which will increase my volume so that I don't need to increase prices quickly. Same thing with my Patreon. You'll see that I purposely set pricing to be affordable globally and relative to the education provided and the opportunities for growth that my members have. My pricing is unmatched given the inflation that we see in the market. So let me share some philosophy with you. The only inflation that's going to happen is the value of my work delivered to my people. If you like this quote, make sure to comment below. Now back to the analysis. Analysts often think about valuation premiums or discounts relative to a company's position in the industry's life cycle. Is the company a startup, in the growth stage, in the shakeout phase, or is it maturing, or is it even declining? This question will determine how the street assigns the valuation multiple. The earlier the stage, the more forgiving the market will be on high multiples, but the more volatile those earnings and sales multiples will be. For mature companies, the multiples that are assigned for valuation are much more stable because the industry outlook doesn't change overnight for them. Now, the second way an analyst can forecast revenue is through market growth and the market share approach. Here, in this approach, the analyst will forecast growth in a particular market or sector. Then the analyst will consider the company's market share and how that market share is likely to change over time. So here's an example. If we have a company that's expected to maintain an 8% market share of any given product market, and that product market is forecasted to grow at 10%, then the growth of that segment could also be approximately 10%. Now, here's one thing the CFA content did not mention, but a lot of analysts use in their decision making, and I'll share this with you. So in this world, you can sell products or you can sell services. Usually products are tangible. You can see them, feel them, and make a purchasing decision from just looking at it and reading reviews based on your needs. For this reason, companies that sell products should be analyzed in terms of how high quality and effective the product is. If you sell services, then customers typically need to speak to real people before they buy. For this reason, companies that sell services should be analyzed in terms of the quality of their sales team and even their sales leader and CEO. How persuasive are they? Do they have the ability to get you to buy into their vision? Companies that have exceptionally strong sales staff talent will greatly outperform companies that have average sales talent. Now, combining everything that I just said, the analyst can then use separate projections for volumes, which are the number of products sold or the number of customers served, and average selling prices to form ranges of revenue projections. Now that we've discussed revenue, which is an important focus point for both buy-side and sell-side analysts, I want to walk you through operating cost analysis. This is important because it tells us about future profit margins and also hints at economies of scale if they're present. So here are some important things to know up front. The first is that disclosures about operating costs is frequently less detailed than revenue. The second item to know is that costs are usually disclosed at a much more aggregate level than the detail used to analyze revenue. What this means is that while we might be able to see the margins at the segment level, we might not be able to see it at the product level. The way analysts typically try to forecast operating costs is through several approaches like top-down approaches or bottom-up approaches. With the top-down approach, the analyst looks at inflation and industry-specific costs, and with the bottom-up analysis, it would start at the company level where they consider segment-level margins, historical growth rates, historical margin levels, and the cost of delivering specific products. Now, analysts can also try to break down the operating costs to understand what percentage of the cost structure is fixed or variable. This is an important concept because fixed costs are not directly related to revenue, and they are future investments in PPE, which is short for plant, property, and equipment, or total capacity growth. Variable costs are linked to revenue growth. Knowing the mix of fixed costs and variable costs will help you understand what is called the operating leverage. If a company has a high level of operating leverage, it means the company has high gross margins and low variable costs. In plain English, that means that every dollar of sales will have a greater percentage of it flow into operating income and therefore earnings per share. Now, in periods of cyclical growth, companies that have high operating leverage will tend to outperform because a macro growth environment will make these companies more profitable. Some examples of companies that have high operating leverage include Salesforce, Ford, Disney, and Twitter itself. And you can see that back in 2021, during periods of bull runs, companies with these characteristics tend to rise faster than the market itself. But the opposite is also true. When consumption growth slows, these companies can be more severely impacted. Now, in future videos, I will be adding onto my investor education content drawn from what I've learned in my industry experience and also academic elements from the CFA. I want to take a moment to thank you and my Patreons for your support. I launched my Inner Circle on Patreon earlier this week, and I wanted to take a moment to go through what types of people have joined me. We have college students who are finance majors. We have investment analyst staff working at family offices. We have FANG engineers, and we also have professionals in poker joining us, which is interesting. Most of them came because they wanted additional insights into my US and China macro strategy, as well as understanding my own unique equity research process. It looks like from the data here that I've collected, the average person in my Patreon prefers to buy and hold and has a tolerance for risk. And in terms of geography, about 30% of my members are from Asia, 50% of them are from the US, and the remainder of them are from Europe, and to a lesser extent, Latin America. Now, for many creators, Patreon is a means for viewers to support creators that they really like. I intend to use Patreon as a platform to deliver a full investment research service at incredibly accessible pricing. Patreon link is in my description, and there's a nice friendly video inside if you want to learn more. Now, I hope this video was educational for you, and if it was, let me know in the comments below. There will be more educational videos like this in the future in between the various topics that I discuss. So stay tuned, my friends, and I will see you next time.